Welcome, everybody. My name's Trevor. I'm with MarketDelta, and we are delighted to have RG from Discovery Trading Group with us today. This is the first of a three-part webinar series, and I know we're looking forward to it. We've gotten already a lot of people mentioning that they're excited to hear what RG had to say. Today's event will be recorded and later posted up to the MarketDelta blog as well as the Discovery Trading Group blog. So if you have to leave early or you want to refer this to a friend, that's where it'll be. Other than that, I'm going to turn it over to RG. The way this will work is there's going to be some questions. I'll be asking him some questions, and he will lead through some slides and some examples. And there'll be Q&A near the end of the session, so you can ask questions. I would suggest holding questions until then, just to keep things flowing well, and then we'll do what we can to answer the questions at that time. So with that said, let me pose the first question to RG. And I guess a good way to start the webinar would be to ask, why don't you tell us a little bit about your background and tell us a little bit just about who you are and why you're here.
Yeah, sure. I guess we're jack of all trades. Hopefully we're master of a few of them or getting close. I guess we learn every day. But we're kind of chameleons. We've got relationships with really three separate companies. One is an algorithmic research and development firm. We develop sort of behemoth strategies for hedge funds and institutions, really big, 50-plus market, trend following systems, mean reversion systems, things like that. So, certainly the stuff that's traded with this, biggest and most significant amount of capital is in that stuff. We also have two proprietary trading firms, which are really, I guess, the catalyst for the blog, where we trade some pretty significant size in the the E-mini S&P 500 futures. We've been involved in trading the futures markets as discretionary intraday traders for, a long time. We're a bunch of old dogs, really. I mean, we're coming originally from the days all we had was the big S&P contract, and only in the pit, of course. We have a few other ancillary things, one being that we have a partnership with a private broker-dealer firm, and that's actually where our trading operation is out of. We have what's called a JBO, Joint Back Office, with two major investment banks and a very large clearing firm. So, I guess that's a pretty good summary. There's a few other things going on, some offshore fund stuff, and but I'd say really the biggest thing is the intraday ES trading in the prop firms and the algo stuff. So I guess that answers it. Hey, Trevor, I'm getting kind of an echo sometimes. I don't know if that's because of mute or something on your end, but I'm hearing myself talk back to myself. I don't know if that's something I have to live with or.
Yeah, unfortunately, you probably have to live with it. It might just be due to, I don't know, right now that everybody's present, we're broadcasting. There may be some bandwidth issues there or something, I don't know.
Right.
I'll keep mine muted, though. I'll mute my phone, so hopefully you have little feedback. And we're sorry if anyone's having sound quality. All we can say is you may try logging out, logging back in, or maybe shutting down other applications on your computer that may be consuming bandwidth. That's about all I could suggest. Okay, next question. Topic of your webinar is about avoiding typical retail trading mistakes. Can you tell us why you think so many retail traders have a tough time being profitable?
Yeah, I mean, first, I think I have to preface this by saying that, I'm not really from the world, but I never came up really through the retail side. So a lot of this stuff I've kind of absorbed while I go, and maybe, that's kind of a good thing because I'm kind of cutting through, a lot of stuff and maybe seeing stuff a little bit more clearly, especially from the angle that we come at our discretionary trading. But for me, the number one thing is mechanization. I mean, you've got this thing that all retail traders have in common, which is that on the one hand, you've got a lot of different systems and people are trying different things, but really, the goal, and part of this is from software companies and marketing, and of course not marketdelta or anything, but there's this integrated thing in a business where you've got brokers, some brokers, software, books, courses, all basically teaching that discipline is mechanization. So they're trying to appeal to the fact that trading, attracts a lot of intellect, and they're trying to kind of get the trading be focused on that because that's what they're selling. Mechanized systems in the course world, in the books, in the software, and just basically coming out and wanting everybody to trade, using a very intellectual approach. We've spent a ton of time studying this stuff, and the volatility and the noise intraday make it really, really tough to have one thing. And I realize that people want that to be the case, and I hate to be the bearer of bad news, but it just isn't going to happen. You're never going to uncover this thing that's going to make you see everything really clearly and be able to execute in a very mechanized way and actually have it be profitable. Like I said, we're heavily in the algo business, and we've tried everything under the sun to develop things that are really successful intraday, and we have, but the cornerstone of most of that stuff involves good discretion. I think that the caveat, though, for that is that you can create optimized strategies that work well intraday, and you can automate them, but you can't be selective. You can't have a strategy that is completely mechanized, but then so you've got all these signals and you've back tested them and they work, and then you sit down and you decide you're only going to take 8 of them. When there's 20,000 signals over the course of a month or a year that you're supposed to take. So I think that's something to keep in mind about mechanization. I think at the end of the day, the real big difference between all the pro traders, that we know and most of the retail guys that we see that are struggling is that the retail guys are really trying to mechanize the entries, the stops, and the targets. They're, doing things like fixed targets and fixed stops and really rigid stuff. But then when it comes to the risk and the capital mechanization, they're not doing anything. They're saying, well, I trade with fixed stops, or I always trade with a 2-point stop, or I won't take more than 2 losses a day. But it really isn't enough. And on the professional side, we really spend most of our time mechanizing the risk and the capital strategies. And then as far as the entry, stops, and targets, we're not rigid on that stuff at all. We're fitting into the market conditions totally, adjusting the volatility on the fly, sometimes changing our opinions up to the moment. So that's a big part of it right there. So definitely mechanization is the key, and not over-mechanizing, and being aware of that in your trading.
Okay, so how do you view risk and money management? What's your take on that?
Yeah, I mean, this is just the extension of the first thing that we talked about, which is mechanization. Using fixed stops and targets is not risk management. I mean, like we said before, that's kind of the appeal of strategy trading or rule-based trading, is that there's this fixed thing that you can do and it'll be successful. One of the things that never gets talked about, which is really the cornerstone of all of our intraday risk models, is physically limiting the number of trades and using that as a basis for risk management. A lot of people are really surprised to hear it, and on our blog, which we'll get to later, we kind of post a lot of different trades from the different accounts, but each one of our intraday accounts, we take just 1 trade a day in the ES, and sometimes that's really shocking to people, and they say, well, how can you make that work? But that limitation is actually, the reason, I think, in large part why we're so successful. if you'll kind of listen to what I have to say regarding this, I think it's going to be a little new to a lot of people, but I think it'll help you kind of bring into perspective how close a lot of you are that aren't profitable are to being profitable. I mean, you really aren't that far away, and the market, isn't out to get you. I know sometimes it seems that way because it always seems like you can lose more than you win, and it kind of creeps up on you. But doing this type of thing to be a basis for your risk management can really make a big difference. So, in our companies, we call it the coin flip principle. Basically, what that means is that if you came in every day and you sat down and you threw a dart at your screen, a good percentage of you are going to really hit that 50% mark or higher just by guessing the direction of the market. And as a nice little sort of experiment, we always advocate that people do this. Come in every day, for a month, a couple months, 2 months, whatever you want to do, and just come in. You can pick any time that you want during the day. I don't care. And at that moment, I want you to say, I think in the next move, the market's going to go up or it's going to go down. Whatever your choice is, you can just guess at it. You can use whatever you think your edge is to decide. I don't really care. The point being is that you're going to put a reasonable risk and a reasonable target that's set to market conditions. Make it be fair to yourself, and see how often you're able to win that battle. So your stop and your target are 1-to-1. And you start doing this for a while, and you start to see that you're able to basically beat the coin flip or the 50-50 market pretty consistently. Now you start adding a little edge in there. You start analyzing a few things, studying a few things, and you start to see how really easy it is to actually beat the coin flip principle. But where it all kind of comes down to your success or failure, and this, again, is something that I think a lot of people don't want to hear, and the reason that, people ask us, why do we make money? Because we're right. You have to guess the direction that the market's going to move. You're trading a key level. If you're going to win, you've got to be right about it. All the technical analysis and everything that you do in the world isn't going to stop that freight train from running you over, and you've really got to get used to that being your reality. If you're trading, you're gambling. Every one of these levels, and that's not a dirty word. You really got to bring it into context and understand, because like all good gambling strategies, I mean, it's way better than Vegas, right? I mean, I'm going to talk about odds here in a second, but, you have to get used to the fact that that's what you're doing. And it's not necessarily a bad thing because, again, if you're not focused on entries, targets, and stops and mechanizing those, being free to develop your edge using market conditions, then you're going to get your edge is going to come from the way that you set up your risk and your capital management strategy, okay? So, again, setting stops and the targets, the market structure, nothing fixed, but let's kind of retrace a little bit and talk about the coin flip principle a little more, just so you understand. So in our accounts, we're going to take one trade every day for a month, okay, in each one of those accounts. And the model basically, and I'll just take one of the accounts for example. We have one of the accounts where typical targets run about a handle and a half, okay, so 6 ticks, and typical stops are going to be no bigger than 6 ticks, okay. So if I take one trade every day, 20 days in a month, right, and I go with the coin flip principle, I know that automatically the market's going to try to beat me half the time if I have no edge, right? So I kind of look at that as the worst case scenario because my risk and my target are 1-to-1 or better, or else I pass on the trade, okay? And I've got this series of trades, and I'm figured to really be doing horrible if I end up at 50-50, okay? So I'll throw out some big numbers here. In that particular account, our model is basically what we call a 1% risk model. We trade 100 contracts per $1 million in equity, okay? So if I win 10 trades and I lose 10 trades, what's my net, right? 0, right? Every time I win a trade, I win $7,500 per million. Every time I lose a trade, I lose $7,500 per million. So what are we left with at the end if the coin flip beats me, so to speak? If I'm operating in a coin flip, I have my transaction costs. Ours are, really low relative. I mean, if you're an exchange member and, you're getting great commission rates. But just for argument's sake for this purpose, let's call it $1.50 a round turn, all in. So basically, if we take those 20 trades and it's 100 lots per trade, our cost of doing business, if we run or operate at the coin flip principle for the month, is $3,000. That's what we're going to lose, because we're going to win 10 trades, we're going to lose 10 trades, and then we're going to have $3,000 in cost, right? But our goal in that account typically is to win 12 points for the month. Really modest goal, right? I mean, a lot of retail traders are trying to win 4 or 5 points a day. These are great returns. I mean, you're talking, 70% plus returns before cost if you're operating at that level, which, in the business is great, obviously. But the moral of the story here is that let's compute the odds there for a second. We're risking, in the case of, I mean, it's not the real risk, but the likely bad outcome for us is to only operate at the coin flip. And we're going to lose $3,000 for the month if that's all we're able to do. But if we win 12 points a month, we're going to make $60,000 per million. So we look at it like we're risking $3,000 to make $60. I mean, I like to have odds like that playing cards. It brings the market into a whole different perspective when you think about it that way. So that really is the reason why you have to try to think about limiting your trades. And even if you're not limiting your trades when it comes to risk management, you definitely have to have a risk-reward requirement that's 1-to-1 or better, and have something that works within that. You really have to spend some time thinking about this and thinking about what your risk strategy is going to be. And at the very least, and this is what killed a lot of guys back in September and October of 2008, is adjusting the contracts up or down when volatility shrinks or increases. And that that was a big thing. You have these 100-point S&P days, and your 6-tick stop now is 4 times as much or more on a typical day. You need to be betting 4 times less the contracts that you're ordinarily betting. So definitely got to do that. We want to trade that constant fixed equity. So we're always setting the stop based on market conditions. And then whatever that is, if the target isn't at least equal to that, we pass on the trade. And then based on what that risk is going to be if we go out with a loss in that trade, we're adjusting the contracts to meet that 1% risk model. So that's pretty much it on risk stuff for now.
Okay, so moving on then, what about technical indicators? Do you use them? Do you have any problem with using indicators? What's your view there?
Well, for us, it's really the difference between indicators that have parameters and those that don't have parameters. We don't really view all indicators as being the same. I don't want to hurt anybody's feelings, and again, I think indicators can be really useful. But for us, any parameter-based indicator that you have to put a number in, and you're going to actually get a different result when you put it in, and your reaction to that number could theoretically be different depending on what it is. We personally don't like to use anything that's like that. So that would be moving averages, MACDs, oscillators like stochastics, RSI, anything that uses historical data and is trying to crunch it to predict the future. That's the stuff that we're really not interested in at all. We like to say we don't use any indicators, but of course anything that you use in the market is technically an indicator. So in the non-parameter indicator world, that's things like volume, order flow, and sort of discretionary interpretation of cash market internals and things like that. So those are definitely 3 things that we're using in our trading. Again, this goes back to the 95% of traders that lose money. It seems like a lot of the things that they have in common are, parameter-based indicators. And again, going back to that mechanization thing, trying to find, this pattern-based thing that's going to, make you see the same thing the same way every time and execute and actually turn that into a profitable opportunity. One of the big things to differentiate in the use of indicators, even if you do use them, is to make sure that you're not using indicators to identify trading opportunities. The difference to me would be, like for us, if, really we should use us as an example, but let's say that you're trading an important level, a support and resistance level, and you've decided that you're going to trade a breakout off this level. You need to develop that opinion and that trading opportunity without using the indicator, using market structure. And then at that moment, when you get ready to trade, if you want to then use an indicator as a filter, I think that can kind of be valuable. I mean, anything that can help you, limit your trades or help handicap your success, which is really what we think of. We always think in terms of odds and handicapping success and what our probability is of this level holding or this level failing. So, if you're using indicators for that purpose, I think it's great. But for us, trading opportunities are all in the price, and we want to be trading where everybody else is trading. They're the big market-moving traders. So again, confirming existing hypotheses is the key, and not having it be, the whole reason for you taking the trade is saying, oh, my SO is pointing up, so I got to get long. That's the stuff you really got to get away from. There's a few things lately that have kind of come in vogue, and again, I'm kind of playing catch up with seeing what's kind of going on in the retail world. But there's a few things that I like to pick on a little bit that are kind of in vogue now, which are just kind of veiled parameter-based indicators, or certainly historical or predictive type indicator things that are being used today. And one of them, and one of my personal favorites, is the whole concept of multi-timeframe biasing. We've done a lot of study in this area, particularly in our trend following modeling, and one of the things that we actually proved is that the whole concept of a larger time frame being a predictor for a lower time frame is actually completely false. It's actually totally reversed, and anything that actually does happen with that is really just a coincidence. What actually happens is the little time frames, which is pretty obvious, they're building into higher time frames and higher time frames, and then creating whatever's happening on the bigger time frames. So really, you should look at it like what you're seeing on the 30-minute chart is actually just a summation of a bunch of 1-minute and 5-minute charts or whatever. And then, if you're looking at it the other way, it's there's just to me there's just no sense in using something like that to determine direction. That if my 30-minute chart is pointing up, then I'm only going to take long trades because that means the market's trending. It really has no basis in fact. So if you are going to bias, like I said, do it the other way. You study smaller time frames and trade on higher time frame charts, even intraday. And I'm going to show you, the only chart that we ever look at, we don't even look at patterns on the chart, is a 30-minute chart. And obviously we do fine. So the next thing that's in that group is price action. I'm a little close to this one myself because I happen to think that price action is actually quite valuable. I've used it in a few different strategies that I've traded as discretionary strategies. In fact, for those of you who don't know, without doing a price action course, essentially what PA would be defined as if the market's making a higher low and a higher high, then we would say that the buyers are in control and the market's trending up. And if we're making lower highs and lower lows, then we'd be trending down. And then the kind of in-between things would be at turning points. We would make a lower high, and that might be signaling that the market was going to roll over on a long trend into a short trend. But the problem with price action is that people, I think, tend to take it a little bit too far. I think it's valuable. You can definitely look at PA and know what's going on, and that's always a good thing to know if you're getting ready to pull the trigger on a trade or something. But once again, if you're using it for a whole reason to take a trade and saying, well, why'd you take the trade? It's like, well, because I had PA with me. It's like, so how do you know that PA is going to continue making higher highs and higher lows? We don't. So again, hopefully you've got some other way to study market structure that you can use price action to enhance and not have that just be another indicator that you're using to predict something that isn't predictable. So the third one, which is market profile, and again, we think market profile is a wonderful tool. We use it, certainly not time-based profiles at all, but we do like to be aware of what the market structure is. And a couple notes on that. Pete did a great thing, and in the pit days, it was really, really valuable because we didn't have all this transparent volume information, and everybody's running tickets on the floor, and so you really didn't really know a lot of stuff until until you could see how long something had occurred, unless you were on the floor. So that was a wonderful thing and a way to see market structure, and I think it holds up to this day. The only problem that I have with market profile is I question and it certainly isn't something that we are interested in doing, and I know some people have success with it, but I question the validity of market profile structure showing what the future structure is supposed to be. I think that the structure is accurate. I think that, if market profile says it was a trend day, or it is a trend day, or it's a double distribution day, or what, I don't even know all of them. But I think that, again, the question is after the fact. What is it really going to do for you to generate a trading opportunity? And I think, again, it should be used as an adjunct to other hypotheses about the market, good discretion, and things like that. So, again, great tool, but be careful that you're not using it as just another indicator to predict what's going to happen in the future. Along these same lines with some of these things, I want to tell the story about how I met NJ. NJ is one of our partners and a very gifted programmer. NJ runs the technology side of the algo company. And the way that I met him is I was working on a project for a hedge fund. I was doing some things for them, and we hired him. And we hired him because I had this really, successful hotshot intraday strategy that I was trading, and we thought that we could automate it. And needless to say, NJ and I went down the rabbit hole for like a year, literally. Not solid. We were working on a lot of other things too. We ultimately partnered in a joint firm together, but in that time, we set out to try to figure out how we could have this thing that I was making money with make money if we automated it, and we couldn't do it. We tried everything under the sun, and we just couldn't figure out. And I would be like screaming at him, going, "Well, tell me that I'm telling you, I trade this thing." He was just beside himself because he said, "I don't know what to tell you. It's not making money. I'm running through the back tester, and I'm like criticizing his methods, and But the moral of the story is that what I didn't realize is that I was using discretion, and that's what was actually making the strategy profitable. And so I had some indicator-based stuff, and I'm not going to go into what they were, but price action was involved and a few other things. And, here we come out the other side, and we found out that the reason that it was working was because I was just feeling certain things right at the time that I was going to pull the trigger, and that's what was making me profitable. And when you put all of those things that I was preventing, the trades that I didn't take, into the mix, it didn't make money. My point is, it's so easy to do that and not realize how much discretion comes into play and can be useful for you, even if you're not that experienced. So that's kind of the moral of the story. Is it the indicator or is it your discretion? And I think a lot of retail traders don't have a lot of confidence in themselves. And you know what? We're not a smart bunch. You probably tell that by now, listening to me talk. But we're not all terribly educated, and we're just street fighting slugfest traders with good common sense and intuition. And these skills are I think fairly easy to develop, and I'm going to pretty much guarantee that a very large percentage of people listening to me talk right now are a lot smarter than I am. So if I can do it, you guys can definitely do it too. So again, it's all about time frame dependence. Making sure that you're not drilling down into this noise time frame. The worst thing you can be doing is using a bunch of indicators strung together that are all parameter based, and you're down there on a 1 or 2 minute chart, thinking that the patterns that you see down there are actually meaningful, and they're just noise. I guarantee you, unless you get lucky and you happen to be trading a pattern that's right on top of where some market-moving traders are trading. So definitely, just if you're going to use indicators, use them to confirm stuff that you've already seen as being important elsewhere.
Okay, so yeah, that was really interesting. How about walk us through your trading process? That might help provide a little more insight to some of the things you discussed up till now.
Yeah, and you guys, bear with me a little bit because it's what you're going to find about us is that it's so simple that you almost think that I'm leaving something out, and I'm really not. And this is what I would really like to impress upon everybody that's either here or comes to the blog or whatever. This stuff is so simple, and the more you insist on complicating it, it's just you just get away from the core of actually why it's successful and it works to trade the way we do. So we trade with pure price, as I said, and no indicators. And basically what that means is that we're only looking at volume at price in order to identify trading opportunities, number one, okay? And then what we're doing is once we identify potential trading opportunities that are based on activity at certain prices, we're using sentiment and discretion and a lot of different things to determine whether we think a level that we're trading is either going to fail or hold. In other words, are we going to fade the level, meaning if price comes up to the level and we're going to trade a bounce off that level in the opposite direction, or we think the level's not going to hold and we trade a break out of the level off of the other side. But as far as the identification of the levels themselves, we're using the auction process. And this is where we have a little crossover with the market profile, because I don't want people to confuse what I'm saying with market profile trading, because to me, market profile is based on the structure and it's based on TPOs. So if it is sort of like, if you think of volume profiles as market profile, fine. I have no problem with that. I don't, but it's fine because it's going to get you to the same place, okay? The auction process to us is not in the context of market profile. There's no detail in it, really. I mean, we're not taking it any further than the reality, which is that you have these prices, and if they're important enough prices, they're being visited by traders that are trading in all different time frames: swing traders, position traders, intraday traders that know what they're doing, anybody trading significant size, etc. And what auction process, and you notice I don't say auction theory, because it isn't a theory, and I'll hotly debate that with anybody. Auction process is not a theory. It's real, and it happens in any market. The ES has nothing to do with it. None of the markets. You could trade what we're talking about here in any market. Futures, stocks, bonds, real estate, Coca-Cola distribution. I mean, anything, because the process is very clear. Basically, it's just about rejection and exception of price and value, right? It's the simplest concept, but when people think about it in the context of markets, sometimes they get confused, or they try to, they go back to the market profile books to figure it out. But basically, this is what it is. When price is in any market, it can't stay still. A market has to move to survive. Why? Because it's only there to facilitate trade. The only thing that's happening in a market is it's constantly moving to try to figure out where it will find supply so that we can trade. And in the process of doing that, we're going to argue over value, buyers and sellers, until we can agree on them, which is what we call acceptance. And when we don't agree on them, that's what we call rejection. Rejection is really very, very predictable, except during certain times. News, in particular, is a time where sometimes you don't get that rejection response initially that you're looking for, and that's something that you'll learn as you go around. But basically, what we're doing is the price is going to auction up to the last possible place where it can find somebody to trade with. Okay, and when it runs out of that supply, it's going to have that initial rejection, because it says, well, we've never agreed on this for value, so you have this initial rejection. And then where we go to is an area of comfort. We auction back into an acceptance area where the market understands itself, and then the whole process repeats, right? So that's the simplest way that I can put it, and I'm specifically dumbing it down because I want you to think of it being that simple. And this is why I like to tell a story of auction process using a real estate analogy, okay? If you're in a neighborhood, you have a house in a neighborhood, and let's say all the houses in the neighborhood, you have an active market and the houses are trading, and every house that's traded recently has traded for $500,000, okay? Now, we have very established value now in this market, so that would be what we would call an acceptance area. So if you looked at that on the chart and you had a volume histogram on the chart, what would you see? You'd see a ton of volume, you'd see all kind of trading that happened at $500,000. Well, now imagine this guy is driving down the street, and he's a potential investor. He wants to buy a house in this neighborhood. Now, it just so happens that you have some opinions maybe about where the market's going to go. Maybe you don't. Maybe you just want to sell your house and get out. Maybe you got a second mortgage. Maybe you want to get more for the house. Maybe you just want to land a sucker and sell the house for more than it's worth. But for whatever that purpose is, you list the house for $750,000. Okay. The guy's going door to door. He wants to find the best house to buy in the neighborhood, right? When he knocks on your door and you tell him your house is $750,000, what do you think he's going to do? He's going to spin around on his heel, and he's going to launch himself off your porch and into the yard and run for his car, right? Because it's ridiculous. He just knocked on all these other doors. It's $500,000. That's rejection. If the market hasn't traded there before, the first reaction is people don't want any part of it. However, imagine if later on the same guy comes back and he goes and he does a little bit of due diligence and he finds out that the city is going to be completing a subway tunnel that's going to land right in outside this neighborhood, and whatever. I don't even know what I'm saying, but whatever. So anyway, he thinks there's going to be an increase in the value in this neighborhood. So now maybe he doesn't reject your price in the second time, and he runs it over, and then the next thing you know, houses are trading for $1 million in the neighborhood. That's the simplest way that I can put to you what acceptance and rejection is like, and it's like that in any market. I mean, if you go to your convenience store right now and the guy says, the Coca-Cola that you bought for 75 cents is now $6.25, you're not going to buy it, right? You're not going to facilitate trade. So that's the basic gist of what we do. So we're identifying trade opportunities in low volume areas initially, and then what we're doing is we're handicapping those areas based on a whole lot of analysis of market internals and our opinions about things, and a lot of discretionary type stuff to determine whether we think the level's going to hold or going to fail, how important it's going to be on the day, whether we think it's an interim support level, et cetera, et cetera. A lot of stuff goes into deciding if and how we're going to trade those levels. But make no mistake, the levels are the levels. Okay. Time frame is something that a huge number of retail traders are overly dependent on. I will tell you that the biggest liberation that you're going to have is if you can manage to let go of time frame you're trading. When I show you the levels that we trade, they are totally independent of time frame. So they're going to look the same. You're going to see them on a 5-minute chart, on a 1-minute chart, on a 30-minute chart, on a daily chart, on a 60-minute chart. They're there. And the reason that that's important is because if you want to have the most success with what you want your trading to be, which is that you're going to have an area that you're going to trade that's going to be hotly contested by as many buyers and sellers as possible and as many time frame traders as possible, because that's going to reduce it down to what you want, which is you're making a bet. You're making a gamble on whether you think the level is going to hold or fail, and as you develop your edge, you're going to be right more than you're wrong, and that's where your money's going to come from. So I know it's a little foreign when you're thinking of trading as an intellectual process, but believe me, all the guys that are doing the best and making money, this is the way they're trading. Okay. The binary nature of trading, you only win if you're right, and if you let go of time frame and you're trading these important levels, you're making sure that you are right at the precipice of where everything's going to happen. Now, we only trade in the first hour typically. That's partly for liquidity reasons. If you trade size, I mean, you got to have enough volume to get instant fills if you want to do all-in, all-out strategies like we do. So the first hour is pretty critical for that, as is trading a market that trades 1.5 million, 2 million trades a day like the U.S. does. But another big reason is the first hour, or at least the first half hour, you'll find a lot of retail traders will sit out that time, and pros are just the opposite. We want to trade there because that's when it's happening. That's when market moving liquidity is coming into the markets, and we don't want to be out of it. The amateur trader waits for the first part of the day to be over with and have the the day trend established, and then uses indicators to try to trend trade through it. It's like find the key stuff where stuff is happening, get in there and mix it up, and when you develop your edge, you're going to find that you're right. And a lot of it, because of that, the levels are so important. Different time frame traders are there. You can be right just basically on the noise that's created by position traders and still walk away with a profit, even though ultimately you were wrong. Again, that's one of the reasons why you want to trade these key levels. So that's pretty much it on that, I guess. And we'll get into more of this.
Tell us, no, go ahead, Rob.
I was just going to say, we'll get into more of this too, and I know this is really new, but as Trevor said, we got a couple other webinars where we're really going to focus in on, the trade identification process and how we use order flow also to time the entries. We can't get to all of it in this initial webinar, so we'll get there.
Okay, why don't you tell us then about the purpose of the Discovery Trading Group blog? Go over that a little bit.
Okay. Well, here's what happened. I mean, we have originally, shared ideas in a very similar way that we're doing on the blog. Basically, what happened is within our group, we started doing a simple process where we would develop a pre-market sheet every day, and every trader would write down the key levels that he thought was important. Whether it was a rejection acceptance level, if there was anything else occurring at the level, like it was an overnight high or an overnight low, or a pivot point or whatever, and then how he was handicapping that level, whether he wants to think about shorting it or taking a breakout over the top of it or whatever, and then we'd do a little commentary where we'd write a paragraph, basically further qualifying and quantifying the stuff that's in the sheet, in terms of the hard numbers. So we started doing this, and just having to sit down and do the work on this instead of just flying by the seat of our pants actually really kicked us up a few notches in terms of success with our intraday trading. And I think it was really NJ that became most intrigued by it and said, this is really good, because it's almost like you're doing, it's like a performance. It's almost like just the fact that somebody's going to read it makes you try to not sound stupid, which I'm probably not succeeding at now. But we would write this stuff down to share it, and it was really great because I could read what NJ was saying and so on and so forth. So, and he would do the same, and then we would have conversations about, well, why? Why you don't think that level's going to hold? Why would you do that, or whatever? And so it really was a pretty good interchange of ideas. So he suggested that maybe we could take it one step further, and for one reason, just to make it easy. We had a little home on the web where we could post our stuff, and it was private. Nobody saw it. And then he said, why don't we lift the curtain? Why don't we just show this stuff and see what people thought, and maybe it would be a way to give back. And we've had a lot of success in the markets, and we enjoy it. I mean, we kind of enjoy the process, and we figured it really couldn't hurt us in any way, and it could only help us grow. So that's kind of the communication, sharing ideas, and it's powerful. So we definitely wanted to see how far we could take it, and it's definitely experimental, but we hope it works out good.
All right. So how should a trader use the information on the blog? And maybe you can show us some examples of what you got up there.
Yeah,
let me sense to everybody.
Yeah, let me just show you what it looks like. So this is what the blog looks like on the front page, and basically what we have is we really have two sections that we post every day. And did everybody see this? This is it. Okay, good. This is the pre-market section, and then I'll scroll up here, and you see the post-market section, right? So basically what we're doing is we come in the morning, and we do all this homework, and we fill out all the information on this sheet, and then we write a commentary, okay? And that's what we share with each other. And generally just one of us does it on the blog each day, because it would be too confusing if we all did it. I mean, NJ and I still share the the stuff with each other, obviously, but on the blog it's just one of us. Typically it's been me lately. So so let me just show you what the pre-market sheet looks like first, okay? This has everything that we need to know about our trading for the day, okay? Obviously we're listing all the levels, and you'll notice that for each level it's either checked rejection or acceptance. Now, loosely speaking, that just means, like I told you before, it's either a high volume area or a low volume area, okay? So what we want to do first is we want to just blindly list all the levels, just try to focus in on on just the high and low volume, put them all in, and then start to really think about them in terms of whether they're particularly strong or not, whether they're coinciding with other stuff. I don't know why I don't have this on here, but this high-low close here, for some reason, this one that I snapped for the day today, I didn't fill this out, but this will be like the overnight high, overnight low, yesterday's close, whatever the prices were for today would actually be in this column. So if you have a level, for example, that's a rejection level, and it was also a previous acceptance level, like this 1205 was, and if you guys that traded today know that 1205 was a really important level. And then we'll have a strength to it of whether that level has been important either one time, or 2 means it's multi-days, and if we put a 3, it means that it's a major, like an interim support or resistance level from an intraday trader's perspective. I'm still kind of addicted to floor pivots because I'm an old school guy, and they're self-fulfilling. Again, it's like an indicator, right? They're just a bunch of numbers, and so I'm not trading directly from these pivots. I don't go, oh, it's a pivot, so I'm going to fade it. I just want to know if it coincides with a floor trader pivot because I feel that many times it makes the level more powerful. So it's just something that I want to know, and it's a little holdover from the past there. Okay, so we have these levels, and now up in this section, anything that's going to be news today we put here. We had consumer confidence today at 10, and I probably should have put the Goldman stuff in there too, but I didn't. But anyway, this all kind of dovetails in with this directional sentiment. Okay, it's very important to take this in context. We are not ever trying to predict the direction of the market in the long run. We're never saying that because it's meaningless in our trading. We're trading around the levels, so really a lot of what we do is reactionary. We wait for the market to tell us what's going to happen around the level. We just know it's an important level. But what we do want to know if there's any pressures that are pushing on the levels in either direction. So we're basically interested in looking at a daily and an overnight time frame, at least initially. In other words, I want to know, like, over the last day or couple days, have we been short or long, and what's the conviction? Do we have a lot of bigger traders, institutional traders, that are pushing on the short side heavily? Because if they're not, then maybe it's suspect. So if I say it's the daily level and we've been selling short, but as a group, but the volume really has been kind of tepid, maybe I'm not believing in it so much, and that's going to cause me to handicap a level a little bit more, differently. Same thing with the overnight. And again, this isn't to be used for any rigid thing. This is just the information that we're using to process how we're going to react to these levels and trade. If there's news, usually that's the 8:30 news that we're concerned with, and whether it moved the market prior to the open. We want to know where it moved it to, whether it's blown off that steam, and then we're going to have an opportunity because of that. So again, we want to know that. And obviously, if we have a gap, usually when you have gaps and they're heavy volume gaps, and you have continuation, those are the gaps that don't close. Today we did, but there was other reasons for that. So again, we're just processing the information as a whole. And then that bottom section is really 2 things. One is the opening bias, and what that is if we have a certain setup in the morning where we're really coiled up tight and we're going to explode out of it, either long or short, those are some of the fewer trades that we'll take that are breakouts. So we try to have a little bit of a bias of whether we thought that the levels are going to hold or fail today, off the open, and that was kind of our direction. And then the high resistance and low support just basically means the bookends around the market for today that is going to be important in the first hour. All these levels are only useful, they may be useful all day, but for us, we're only putting them in the context of what they're going to be roughly in the first hour or the first time they get hit. So all I can tell you is that I think the level is going to reject the first time it gets hit. After that, all bets are off because by then we've probably traded it. I don't know how it's going to build the rest of the day, so that's a little disclaimer on that. This is for first-hour trading predominantly. So the high resistance, low support, do we think that it's going to fail? Do we think it's going to hold? Today I felt that the high side would hold, above 10, and I was right. I felt that the low support would eventually fail. It did. So, some days we're going to be right, some days we're going to be wrong, and we're processing all of this into, the information. So that we're going to use to determine how we're going to trade these levels, in which direction. Actually, I need to show you one more thing. The trade section, we abbreviate a lot, so you guys will have to get used to that. Obviously, 525 is 1205.25. So they're never exact. The market moves these levels, and today you see, 1205 was the key rejection area, and it was, but did it go right to 5 to the tick? Well, actually, I think it did today, but sometimes it doesn't. So we're putting here whether we're going to fade it, and if we're going to fade it, what targets we're going to look at, and we always give ourselves a couple, because if we end up having to sell this because it doesn't really quite make it and it fails and we get short at 450, obviously we're not going to target 4. So we try to find key acceptance areas that are close enough. If they work out, we put them down. If not, we probably pass on the trade. We don't even write them down. So we had a couple fades here, on the short side off the open, and we had a couple things that we were willing to trade for breakouts. Obviously, we had meetings today, so we didn't catch that move down. But we're staying really where the structure is favoring for us to break out and sell. We're never really trading right at the breakout level. We'll wait for it to get past there and then find a level to get in. And here's our long trades. If we have, obviously the fades I already explained. If you go up to a level and you turn around, that's a fade for anybody who doesn't know that. Breakout would be in the direction of the trend. The market's moving up to a level and it breaks through it, either up or down. A scalp basically means that I'm afraid of it. So I don't really want to write fade and I don't want to write break, and I'm basically saying that if there's cool volatility around there, I'll trade it for a tick or two. But I'm not making any promises, and maybe I'll put a target, and sometimes you'll see me put a question mark. So that's really, this is the sheet in a nutshell. And you know what? You just got to study these and kind of get used to how we do them. It'll be so clear after a couple days. It'll make this explanation seem worthwhile. With the pre-market commentary, we also post our trade identification sheet. Remember I told you that all the trades and where we identify that we're going to trade come from this one sheet, this one market delta sheet. This is the profile indicator with volume profiles. Obviously, we're importing tick level volume. We're trading, we're finding the levels within the profiles and the whole market structure that's here, and we're determining where we want to trade for the day. You can see pivots over here. I like to look at day session only pivots and 24-hour pivots. That's why you see these double pivots. Some are colored and some are gray. And we'll go over more of this stuff in the charts later, but this is basically where we get all the trade structure comes from here. So we post this too. So if you want to look at our levels and see, where we got them from and all that, you can see it there. The really key part of the pre-market commentary is right here. This part right here where we write all this stuff down. This is where you can tell really what we're going to do. I mean, because all these levels, you never know which ones we're going to trade and which ones we like and which ones we're afraid of necessarily, unless I'm saying I'm scalping it. And this is really where we process the information. We write down exactly what we're feeling for the day and what we're going to be looking for. And we'll say things like, watch out here. This level's squirrely and the volatility is going to be weird and you might get crushed and, be careful and all that stuff. So the commentary is probably the most important part of this if you're trying to follow along with what we're doing. Okay. Fast forward, we're done for the day in the first hour, and then we do this. And this is the post-trading analysis. So I'll write down exactly what we encountered, okay, and what we traded. And then this is our footprint chart, okay? This is what I use to enter. We're going to have a whole webinar on how we read order flow using both the open orders and the prints, which is coming from right here. All you guys are market delta guys, you probably already know what this is, but we're stripping the aggressive hits on the bid and the aggressive hits on the ask market orders and taking a look at the volume that's coming in the market, and we're making decisions based on that and trading order flow. You can see today that we're the real deal because we're actually posting that we lost the first trade today. So, but look, we made a tick on that one. We scalped it. Actually, I think we came out 2 ticks ahead because right after this, I finally bought that long. I think I bought 6 and traded into the gap fill. I'm pretty sure that was the trade. But so we redeemed ourselves today across all the accounts. So anyway, we're going to get into more of this later. This is, we're going to go into a whole detail where I'll explain everything that's on this chart and how we use it and how we read the order flow in real time. We're going to have a whole webinar on that. So that's pretty much the blog. One of the things that we really would love to see with this is have you guys develop a community. we have certain limitations, which I'm going to go over next, and how we've set things up in this blog. But I really would love it if you guys would put the word out to other traders, and again, we would love to see you guys really, start posting and interacting with each other, and using our stuff as a springboard for your own stuff, and telling us what you traded. And we like to learn too. We like to hear what people's ideas are. And right now, there's a few people that have posted, and we haven't really gone public yet. So there's just a few. We haven't announced it until today. The webinar is actually the kickoff for the blog. But we'd love to kind of have you guys just go there and come every day and get our levels and see what we did and run playback and study that stuff and compare with what you did, and really make it into a community. I would love to. Nothing would make me happy to see 1,000 people coming there every day and interacting and talking about trading, because then I'd feel like we really did something cool and made something that was real, and it's just nothing but the truth, in trading, and that would be great. So we have a potential issue here, and it was something that we didn't think of when we initially started this venture. I guess I was more naive, than NJ was, because he was like, no, you have no idea what's going to happen. And I was thinking that we just sneak in here, and obviously we use the MarketDelta software. Trevor is just a great guy and a great company, and if you guys don't have it yet, you should get it. There's nothing like it on the market. We just started talking and about webinars, and then Trevor kind of proposed the idea, and it was like, yeah, maybe we could do that. And Trevor would tell me, this is you're going to get a lot of people who are going to be interested in this, and I just never had any idea what it was going to be, and the kind of response that we would get. But we ran into a little bit of a quandary, because we're posting this stuff, and this is like the playbook, right? We're giving, we've got all of our levels, we've got every little detail of, how we're interpreting levels. Anybody who's looking at that pre-market commentary and the levels is going to have a really good idea where we're going to be looking to trade. And we don't really care about that. Like, we're not trying to, hold anything out, nor are we trying to make this a commercial enterprise at all. Thankfully, we don't need the money, and that was never the plan for the blog. However, we do have an issue, and that's that we got to just put our toe in here at first, because even though the ES is a really liquid market, and I don't think we're going to have any problems, and certainly not with 1- and 2-lot traders if that's what it is, but I just got this lingering fear, that some people are going to come in, they're going to get the stuff, and it's going to start getting posted on forums somewhere, and then some big trader's going to get a hold of it, and then I don't think that anything that we're saying is anything that's particularly edged, other than the just common sense of our risk. I think it's I don't think that anybody could ruin our trades or anything. However, if at every place we tried to trade we had thousands of contracts coming and running us over, that wouldn't be too cool. I don't think it's going to happen, but because I'm not sure, we have to proceed the way that we're proceeding. So, you got two things right here. We got the data that we're giving you at 4:15 in the afternoon, or getting it at 9:30 in the morning. We're giving you the exact same stuff whether you're getting it at the end of the day or in the morning. However, when we proposed that we were going to post the information at the end of the day, we had a whole bunch of people go, no, we want it pre-market. And I'm very confident that every one of those people that said that are small traders, and we're happy to give it to them, and that wouldn't be a problem. However, now you got everybody that wants it. So we had to figure out something to do. So basically what we came up with is a little thing that's just this nominal thing that we call this premium membership. Now basically what it is we're going to limit it to 50 people initially. And again, we may open it up to more. We may, who knows, maybe in the future, if it's not a problem, we won't even have a pay membership or whatever, but initially we feel like we got to do it. So please try to be understanding about it. The other thing is the limitations of answering questions, and again, I just throw that in there because that's another thing. You got everybody asking questions all day long, and we just don't have time to answer them, so we have to limit that too. So wrapped up in this premium membership thing, we're going to take 50 people, and we're going to charge this nominal amount, $99, and you can get the stuff in the beginning of the day. The only reason that we're charging it is because, if we don't put some kind of a price tag on it, then it's not meaningful, and we don't want to charge a lot for it either. So we think that'll work, and we'll just have to see how it goes. Maybe we'll open up some more, maybe we won't. In addition to getting the information pre-market before 9:30, NJ has set up along with our admin, has set up a private Q&A forum. Like I said, if we're going to have thousands of people coming here, we're not going to be able to answer everybody's questions all the time. So, what we've done is we're just going to make it to where we'll interact with those 50 people on a heavy basis and answer specific questions about setups and trading stuff. And for everybody else, you'll just have to wait for the webinars that we do and try to learn from those as best as you can. Now, keep in mind, again, now that we've kind of covered the 9:30 crowd and the 50 initial members, at 4:15, you're getting the same thing. And I encourage everybody who maybe doesn't fit into that category that they really want to have the stuff pre-market, come back in the afternoon and get the stuff and compare with what you're doing. Run playback. If you're a MarketDelta user, it's awesome. And obviously, we're going to use it in the webinars quite a bit. And you can really study what we did, take a look at the order flow analysis, take a look at how you perceive things, and really get a lot out of it. And we hope that'll be the case. And all the stuff that I just showed you here will be exactly the same. There's no difference other than being able to ask us direct questions and interact about the stuff and getting the stuff ahead of the time. Then that's the only difference. And we're giving it away to everybody else, and we'll try to help you guys any way you can. So that's pretty much it. I don't have anything else, Trevor. If you have anything to add.
No, that was good. Why don't let me say one thing, and then we can move into the Q&A. I know there's probably a lot of people that came here maybe expecting to see a lot of market delta footprint charts or something like that.
Right.
This is a 3-part webinar. There's going to be another one next week, probably a week from today. I think that's what we settled on, and then another one after that, probably a week later. And there'll be a lot more chart. Yeah, go ahead.
Yeah, the first one's going to be the trade identification. How we find everything, figure out what we're going to trade, what we're not going to trade, using that profile chart, the 30-minute profile chart, and some other things too, which we'll integrate into that. And then the second webinar will be just on the footprint chart and reading order flow, and that'll come a week after the first one.
Yeah, so there's a lot more good stuff to come, but this webinar is certainly fundamental in understanding kind of how you approach the markets, who you guys are, and all that. So with that, I just wanted to mention that because I'm sure there's a lot of people thinking that. So with that said, why don't we move into the Q&A? If you have questions about what was talked about today, go ahead and let them fly. And Rob or Art, you do your best at answering these, probably just audibly, and we'll go from there. Probably best to read the question. Look at the question because everyone can't see them, so you're going to have to read the question out loud and then just
okay. All right,
do your best to
first one here. Hi, Rob. I've actually just subscribed because I'm really interested in what you do, but why are you helping the opposition, i.e. a heads up? Okay, Dave, that's a good question. We really don't think we're helping anybody. I mean, if you see the way we trade, it's just, again, we go back to that trading being binary. Everybody has different opinions about these levels. It's like I would go stand on my roof and tell everybody I was shorting 1205. Nobody's listening. It's for every trader there's going to be somebody else that goes, what, are you crazy? I'm building a position here, and I'm trading into the retest of last year 2 years ago's highs into 1221, and I want to get long here, and I think this is a good spot, so I really don't care if you're selling. So I think ordinarily, if we had what I would call an edged system where we had sort of developed a mathematical edge and a really systematic type thing where there was a rule set and we knew that it made money and nobody else knew our secret code of what the values were to plug in, then we wouldn't share it with anybody, and that's certainly the case in some of our algorithmic stuff. We call that lifting the skirts, and we don't lift the skirts on stuff like that. But this is just sort of nuts and bolts order flow trading, and there's no secrets. It's just that if it becomes really famous and everybody goes, oh yeah, well, there's these exact spots, and then, we're trading, 5,000 on the offer, 5,000 on the bid, and then all of a sudden we've got, half of that volume is now from new people that are coming in that are, just happen to be trying to trade our levels. I don't think that it would hurt us in a meaningful way. It's just, we just feel that we need to protect it a little bit, that's all. So hopefully that answers the question. Does your research show that 2 to 3 ticks is the limit of non-random price action around target entry price levels? Is that why you only trade for a few ticks? No. I think what it comes down to is if we're contrarian traders mostly. We don't trade a lot of breakout trades. We tend to look for levels that are going to hold in rotational patterns with nice rotational market patterns, and we tend to trade for a few ticks there because the risk is only a few ticks, and so we want to try to win as many trades as we can because that's just kind of how we're aligned. I'm a little more so than NJ. NJ's, I mean, we should rotate a little bit and have him post his trades a little bit more than I do because I'm the scalper. I've spent a lot of years scalping and have really good tick scalping skills, and NJ is more of a, I call him the long-term trader because he stays in for 2 handles. But no, typically, I mean, my trades are usually 1 1/4 to 1 3/4 ticks. But okay, let's see. Are you using the volume breakdown study at all? Yeah, a little bit. I've just started to look at it a little bit. I'm seeing a lot of that stuff in the order flow, but I do like to know about divergences, delta divergences, and in relation to the volume breakdown indicator. And yes, I do think that it's useful. Why the 1/6? I guess you're talking about the 6 reversal chart, the point and figure. The reason that we use a 6-point figure is because a 4 is too small and a 5 is kind of in the middle. Basically, when the way that we read volume information and trade the order flow, having a single big candle is always a good thing. When we change to a new bar too often, it throws off being able to count the volume at price the way that we want to. And I just find it easier to read a 6 than anything else. When looking at volume and order flow on a second-by-second basis for a 6-tick trade, is that not just noise? What are you looking for to trigger a trade? Good question. No, it's not noise. The majority of our contrarian trades around areas that the key levels that we trade as rejection areas are predatory trades, 100%. We are preying on weak retail traders that get sucked into chasing the breakout, and when they do, there's a certain behavior of volume around that, particularly a lot of volume flows into a level, but they can't advance it because they run out of supply. Then they panic, and when they do, they start hitting the sell button, especially around their stops, which are all basically clustered, starting at around a point or so. Most retail traders are 1- and 2-point stops, so we're basically trading just like we, I don't want to be too harsh, but it's really predatory trading. We're trading like market makers. We're trading for your stops, and we're successful. So it's ugly but true. So it's not noise. I mean, sure, the stuff around that area is probably noise, but I don't care because I'm looking for to find stops to hit. So, what periodicity are you using to trade an ES chart? We are not using any periodicity. If I have any periodicity on any of the charts, it's because I can't have the chart on without having a periodicity on it. I could care less about any of it. Periodicity has nothing to do with anything because I'm not trading any patterns. Even with to go back to the last question with the point and figure chart versus a minute chart versus anything, whatever is the easiest for me to see the volume picture that I'm looking for is fine. A lot of times I'll have, like I said, I never leave the 30-minute chart almost ever on the trade identification chart where we have the volume profiles. But again, don't misunderstand me. I'm not trading a 30-minute chart. I want to put as many profiles as I can on a page so I can see where the key areas are in the broad sense of the market. So I'm not, the 30-minute is irrelevant because I'm not trading any patterns at all on the charts. The bars, I should actually turn the bars off because I really don't even need them, which would be more like, volume profiles on a market profile chart. But so hopefully that answers your question. Is the second and third seminar free? Yes. No, you don't need to be a premium member. We're gonna show you everything that we know. We're just going to limit the amount of traffic that we have initially. I'd like to subscribe but don't have a PayPal account. Email NJ or admin at discoverytradinggroup.com, I believe. With profile and volume and statistics, which profile is based on Gauss normal distribution? I have no idea what you're talking about. I don't know what that is. I'm just a dumb pit guy. Let's see. So write again, and then I'll know what it is. It's basic statistics. I did terrible in that class. And they didn't make me study it in college. How often none of your trading levels reached during the first hour of trading? A lot of them aren't reached. Again, we don't know if we're going to have an explosive move, and we don't know if we're going to pass on the first levels or not. So if I have a bunch of let's say today I had 1205 and 1210 and 1213, I'm putting them all within a really wide range because I don't know which one's going to come up that we're going to like. We might not like 5, and we might pass on it and say, you know what, let's wait for 10. And we might not like 10. That's the answer. I mean, we don't we don't want to miss anything. Rob, I used to be a prop trader, and I used to register all levels of meaningful volume during the day and see which one would be tested logically the next day, and a few other traders were also doing it more or less the same trading. 100 contracts and DJ Euro stocks. Yes, great market. In fact, we're expanding into that market very soon. I love that. I love that market. Yes. Thanks, Marlene. Yes. I'm enamored with Marlene now. Yes, we are very close to launching a account and actually an offshore fund product using the DJ Euro stocks with the same type of price trading that we're doing here. Could you please kindly go over the flip coin, the coin flip, with number of ticks for stops and targets, please? Yes. Again, Marlene, this is not mathematical. I'm just trying to give you the sense that this is a way for you to understand that the market isn't trying to beat you necessarily. It's something where you have so many participants. This is why, right? You have buyers and sellers constantly beating themselves up over value. So basically, what do you see at the end of the day? Even if you see, you guys are market delta guys, so you look at your deltas, right? They're never really that big, and the reason is because it doesn't take very much to push it over to one side, but at the end of the day, you have a ton of buyers and a ton of sellers. Those numbers are always very close to equal, right? So the coin flip principle is really based on that in terms of the numbers, let's just use an example and try to fit it to your trading. In our case, well, let's say my trading particularly, most of my trades have a stop that are no bigger than 6 ticks, and most of my trades have targets that are no bigger than 6 ticks. So if I take 20 trades in a month and I have 6 ticks of risk on each, on the loss side and on the win side, and I'm running at a coin flip, meaning that I'm not even guessing. I'm not using any analysis, and I'm just coming in every day and going long, short, long, short. I'm going to win half of them, and so are you, and so is everybody else over time that's reading this, right? So my point is that if no matter what I'm betting, okay, and that's why I use the 100 contracts per million model. If I'm trading 100 lots, then with 100 lots, a 6-tick win is 7,500. A 6-tick loss is 7,500. So if I trade blows with wins and losses all month, right, and I win 10 and I lose 10 because I'm limiting my trades, 1 trade a day, 20 days, period. I do that every single time, right? Then what do I have, right? I've got 10 wins at 7,500 and 10 losses at 7,500, which is a scratch, right? I made nothing and I lost nothing, but I have my transaction costs. I have 20 trades. They're 100-lot trades, $1.50 around turn. I realize everybody's paying 3 times that, or maybe not quite, but at least 2.5 times that. Again, it depends on exchange membership, whatever. You got electronic corporate membership, full exchange membership, leases, whatever. But even if we'll do this example. Let's say you're paying $3 a round turn. Your cost to basically let the market beat you, which is to act about the worst case scenario, which is only at a coin flip. You're running right at no edge, right? You lost $6,000 per million for that month, which is, it's nothing. It's not even, a point, right? So, percent, I mean. So you end up there, and so now you're saying, what's my most likely event? What's my most likely outcome, that's going to happen month after month of trading? And in our case, we're pretty steady at about 12 points a month, taking 1 trade a day. That's our goal, and it's a reasonable goal because we hit it almost every single month, right? We win 12 points or more. So at 12 points, I'm earning $60,000 per million, right? And my likely loss, if I lose, is that I'm going to have no edge at all and go out at the coin flip and incur my commission cost, which in this case at $3 a commission would be $6,000, and $1.50 would be $3,000, right? So then you start, handicapping that for like odds, right? You're risking, $6,000 to win 60. You're getting 10 to 1 on your money. Okay, that's how we handicap our trading. Okay, so hopefully that makes sense. And you can do it obviously with anything. 1 contract per 10,000. That's the model. But you need to be trading more than 1, obviously, so that you can adjust, for volatility. Would you say patience and execution and the most important attributes of a successful trader? I would say instinct probably is. I think you do need to be patient. Yeah, you can't just be wanting to trade. This is a big part of why you want to pick your trades ahead of time. Really know where you want to do your trading for the day, and kind of that's it. I'm gonna I think 1210 is going to hold today, and I'll wait all day if I have to. But if the market rotates up to 1210, I'm going to try to get short there and make myself a point. And you probably will. I mean. We certainly do, so it really isn't that difficult. Let's see. Do you look at market profile, value area, high value area, POC levels? No, I don't. Standard deviations of volume, yeah, I'll look at it. I mean, I don't. It's nice to know that it's there, and maybe some people are looking at it. Do I see the market reject off of market profile value areas? Yeah. Do I see it accept around those areas? Yeah. For me, they're still not as powerful as, you mentioned the POC. I don't look at TPO POCs, but I look at VPOCs, VPOCs. Yeah, I mean, we're targeting VPOCs on our trades most often. That's our baseline. We're always willing to adjust it if we need to, but we'll definitely look at those. Sure. Do you use market delta in your tick scalping? Yes, absolutely. I'm using it to gauge exhaustion, and that's where I'm scalping for ticks. I'm waiting for price to approach a key level, and I'm waiting for it to die and for it to completely run out of supply, and I'm scalping for a tick absolutely by using the footprint chart. A little caveat on this, for years I've used the DOM and reading the order flow from the DOM along with prints and everything else. Market delta is no contest how much easier it is. And you have the history and you can look everything up, and it's a wonderful, wonderful tool for that. I just can't say enough about it. And Trevor doesn't pay me anything to say that. So it's completely unsolicited. Let's see. What criteria goes into the decision to pass? Yeah?
Yeah, here's a good question. I think it was kind of a follow-up on one of the things you talked earlier. He mentioned, what criteria goes into the decision to pass on a level when price reaches it? That
Yeah,
may
I
be
just
something
saw that
to cover
one.
in a future
Yeah.
webinar. Oh, you got that one? Okay.
Yeah, well, I was just, it's funny you said it. I was just looking at that one. Yeah, good question, Mike. The criteria is a lot of things, and it's not there's not a list. You know, it depends on a lot of things. Maybe certain things that are going on with news items, certain things in the market structure where I see that a level has been hit a lot, and I think that it's going to break down because it's been tested too many times. It could be something to do with something that I'm seeing in market internals, where I'm seeing all the sectors in the cash market stand up and start to sell off, and then I'm thinking I was formerly going to fade a level, and now I'm like, no way, I'm going to get run over, right? So I pass on it. And again, I mean, it's a great question, Mike, but it's all about being nimble, right? You have to be able to change those decisions on the fly because that's reality. That's what's happening in the market every day. Besides 3 free webinars, do you provide any other education to premium members? No, we really don't. I mean, like I said, Michael, we didn't want to be educators. We didn't mean to be. This whole thing kind of evolved, and all we can really offer is the education from the webinars. I'm not saying that we won't do more webinars, but I will say that probably everything that you need to know and that we're willing to talk about will be in these webinars. You know, one of the problems that we have is with some of this stuff, it's impossible to teach because I can't tell you. I mean, I can't tell you. Oh, well, you know, I look at, for example, I look at 15 cash market sectors every day. And it's completely esoteric. I couldn't tell you, oh, when 10 of them are pointing down, I do this, or if one of them's going, you know, I couldn't tell you, so it's impossible for me to teach it. All I can say is that if you embrace the foundation of what we're doing, and you just understand basic, you know, the auction process and what's happening in levels, and you know, really just making sure you're handling your risk and you're trading around prices that you know that multiple time frame traders are trading around. You're going to be in good company, and those are where the market-moving events are going to happen. And then you've got to develop your own chops. You know, you've got to look at your own internals and look at your own things and make discoveries. You know, like we did. But they're feel things. You know, a lot of them. Do you look at trend and tick as part of the internals? Not the trend, yes, the tick. I use the ticky. And I use the S&P 500 ticks, not the NYSE ticks. S&P 500 ticks and the ticky, and I like to know when the ticky is extreme, and I like to know when the S&P 500 tick is extreme, and I like to study the cumulative ticks and know where those are at during the day. And again, I don't have a system that I can tell you, but yes, I do look at them. Guy asked too, you mentioned market internals, what else are you watching? Cash market sectors, the VIX, the ticky, the S&P 500 ticks, S&P premium against the cash, the over-under, which is, I want to know when program trading is initiating, and that is pretty much it. Do you limit orders only? Yes, no market orders. Does MarketDelta provide cash market charts? Well, no. MarketDelta is not a data provider. MarketDelta is a charting package, and anybody that you would turn on for data would provide those things as long as it's not a broker data feed. Brokers only provide the data for, you know, the instruments that you're trading, the futures data, because that's the data coming out of the order servers where they're processing your orders. You need to get a data package from somebody like DTN IQ Feed is excellent. We've just switched to them from eSignal. We're very happy. And so you should get IQ Feed if you want to have those instruments. They're relatively cheap, and it's clean data. It's great. We're happy with it. What symbol for S&P 500 tick? Oh, God, I knew you were going to ask me that. I forget. It's like I can't even, it's like JT6T or something, and I don't have my program open right now, so I can't tell you, but it's something crazy like that. You can also build your own. You could bring your own ticks in. We used to do that. I haven't done that since we have IQ Feed, but let me find something else. Will the password be emailed this evening in order to get up to speed for tomorrow's open? Thomas, I think so. Email admin or email NJ. If you don't have access to footprint charts, will you still be able to get value from being a member? You know what? I guess. Although you should probably try to do the whole process if you're going to take up one of the slots. You know, you should get it. I mean, you should be watching the order flow. It's really critical to our trading. As far as identification of trades and what we're giving you, I mean, we're not giving you anything with the footprint charts pre-market. I mean, all we're giving you pre-market is our trade identification and our commentary of what we think about different levels that we're going to trade. We don't, I mean, but if you really want to study the way we time entries and do those stop runs and things like that on scalp trades, you're going to need it. You won't be disappointed. You'll easily, once you get good with it, you'll definitely justify the cost, I'm sure.
All right, Rob, why don't you take another question or two, and then we'll go ahead and wrap up, and I'm sure we can facilitate more questions in the next webinar.
Okay. Just to clarify, this isn't a live room, but reading posts on a blog before or after market hours. Yes, not a live room. There was one other that I saw. Do you use any algorithmic stuff with these techniques? No. Man, what was that question? I saw that one that I wanted to get. Oh, you say you only do one trade a day, but you had 3 trades today. Yeah, Stuart, I'm familiar with you. You watch our blog. Yeah, we have multiple accounts and that we trade. And what we try to do is any trade that we thought would be good for you to see, we'll just combine them all and mark them up on one profile chart. But we have different accounts that have different objectives. Some are just scalping, some are shorter term, some are longer term. So anything that we think is relevant, we'll put in there. And there's a lot of accounts. So I'll do one more. Get down to the bottom to get some of these new people. Yeah, Lenny just posted the S&P tick thing. It's jt6t.z. Do you ever scale in? No. Scaling in is mathematically disadvantaged. If you're going to scale, scale out. Don't scale in. What do you think, Trevor? Is about it?
Yeah, that's good. That's an hour and a half. I think that's good. It's the end of the trading day and everything. So why don't we wrap up with that? Certainly appreciate the time, and it looks like everybody's pretty happy here based on the feedback. Just so everybody knows, this was recorded and will be posted to our blog and the Discovery Trading Group blog here in the next couple of days. You'll also probably get an email. And I'll try and include that link in the email so you can just download it directly. That's probably going to be better since it'll be a large file. And then there'll also be another email that comes out probably in a couple days for the next webinar, which will occur next Tuesday, a week from today, probably the same time. There'll be a new link. You'll need to re-register, so just register for the next webinar, and there'll be kind of pick up where we left off. So thanks again for taking the time today, and Rob, really appreciate it. So
hey, thanks for having us. We appreciate
that's it. All right, thanks everybody, and we'll see you in a week.
Thanks, guys.